All right, everybody, welcome back. Hope you all had a good 3-day weekend. The next event of note is on the 23rd in the evening. It'll be when Japan makes their rate decision, and it's a pretty big deal. So it's certainly something that we want to continue to focus on. Looking at the world right now, we've got a mixed bag. You can see the US markets are doing okay. I mean, they're in the green, certainly not ripping like wild. Small caps are up the most, and Hong Kong is down the most. Europe is basically flat. We don't have a lot on the table today. If we look at Market Watch, which is where we want to go for US events, this one's really limited, this site, although I still like to look here every day. With this site, it's only going to be the biggest events, and if there's nothing that they deem to be big, that it won't be here. And then it's only going to be for the US, so it's really limited. But it's like a quick glance for, is there anything big today? This is FX Street. It does a much better job, more nuanced, looks around the world, and has this impact gauge. That way, if you're, say, newer to all of this and you don't know which economic events are more important than others or may be more impactful than others, this would be a good way to go. Just remember, we check multiple sites every day, and we're still not getting every single economic event. And just because it's not listed here, don't make the assumption that it must not be important if it's not listed. QRA is a really big deal, and you'll never find it listed here. That's a quarterly event. It's a really big deal. And yet you'll never see it, right? So you can check as many sites as you want. You can try to find every single event, but I promise you won't get them all. Instead, just focus on what time of day it is. These are all connected to the government, or they're all connected to the market, and that means they're going to come out on the hour, on a half hour, sometimes on the quarter hour. And that gives you a little bit of a leg up because you can just watch the clock, right? Just recognize that on a new hour or on a new half hour that we could see some liquidity come in, wipe out your stops if you're, trading with a tight stop. So this morning we have some data coming out of Canada. We're going to get some auctions around lunchtime, and that'll be a wrap. What this is not telling us is now that we've got the new administration in place, all the news is focused on that. So you want to keep your eye on something like Finance Juice. This is a news aggregate website. It's getting news from all over the place. You want to make an account here. It doesn't cost you anything to have an account. So, at least get the free one. And that way you can use the filter and you can turn off the different news sources, or at least choose the ones that you want. I don't know about you, but I'm not really interested in CNN, Fox News, MSNBC. That's trash. I don't need it. So use the filter to turn that noise off and focus on things that have more relevance. Throughout the day today, and really probably, for the next couple of weeks, the news is going to be on what the new administration is doing, talking points, people out there chipping teeth. So it's not necessarily going to be the scheduled events, which we also have, but it'll be those speakers. You're going to want to know when those are coming in. That way, if they say things that move the market, you're already aware of what was happening. So last week, we were talking about this new high that we needed. We had that red day and we started to pull back. The concern was that it was going to set another lower high. Now, depending on the analyst who's doing the work, we have to have price make a large enough swing for it to be considered another pivot point. If it's one candle, a lot will argue that it won't count as a pivot, right? That it didn't pull back enough to be considered as, in this example, a lower high. So that's why we don't have it marked. We do have this push that brought us into this pivot point here. We need to follow through with it. Otherwise, if we start to pull back, we're going to have, nearly an equal high. Now, I've mentioned before, if we get equal highs or, if we wick through it above, just barely miss it from below, and we fall back, it's still going to just be a complex topping pattern. We would need a definitive break through this level and say push all the way up into the next level before we would consider that this pivot has been taken out. So in the grand scheme of things for right now, that's where we're at. We're still in this complex topping pattern. Nothing has been resolved yet at all. We don't have the AM edition of the Founders Note in Spot Gamma yet, but we do have the levels, and the put wall is still all the way down here, 58.37. The call wall way up here, 61.37. We've got the volatility trigger and zero gamma underneath us, along with the 3-week moving average, the 20-day, the 10-week, all of that as structure underneath us. So we could break down, we could get through those levels, but it would take a lot of work to get that done. This is the ADR levels for the day. We're closer to the upper edge, which implies we'll go ahead and get up there and hit them. To hit the upper edge at 60.80, it means we're going to need to break out of this range that we set yesterday. Now, on these short days like this where we've got missing data, what I like to do is take that day and add it to the last day that we did have. So I would put Friday and Monday together. Just tie all of it in to one piece of data. Still, that is the highest point if we do put those two together. And we're looking at a breakout of that level to get to the ADR. Liquidity resides on the other side of the pivot. That is our pivot. It's very unlikely that we'll make it through this red line, this lower ADR here, and go higher without some significant news to drive that push. To the downside, we have that big candle. There was a lot of news that was coming in, right? And statements that were made, even some off-the-cuff remarks to reporters about the tariffs. We had the dollar making big sweeping moves. It was pretty crazy stuff. This candle is like a liquidity event or a liquidity gap, and we did close it. And you can see that doji bar when we got there. When we finally got up into that spot, it was immediately rejected. We don't know if there's still liquidity here that needs to be resolved because we didn't completely run through it and go up. So until we do, that's the level of concern. It's the start of that really big bar. Let's get completely through it, hold above it. That'll tell us that we've taken out that liquidity gap. Then we can focus on the high of Globex, then the high of yesterday, and then this ADR half, and work our way up into 61.32 cog line up here. If we reject, we want to take this entire thing, this entire big bar, focus on the half back of that, 60.32 cog line, or 60.35 is the measured half. Then get through the low of Monday, 60.17, our own Globex low, and then Friday's low. Right, we got the ADR half down here. To even get there, we got 60.11 cog line, 6,059.92 cog line, then the ADR half. All those pivots will come into play, then Friday's low, then the full ADR down here. Now, that's a lot to work on in either direction, right? Higher or lower, we've got a lot of structure around us. when we start tying in call wall, put wall, volatility trigger, zero gamma, we're just buffered on each side, completely surrounded. We're done with OPEX now, so that should have adjusted the call and the put wall considerably. Still waiting to see Spot Gamma's AM edition founder's note, see what they have to offer on Insight, which it looks like they just came out with it. So I'll get that published. They're still showing on the SPX 6000 as support, resistance at 6050, 6075, and 6100. Yeah, and they're laying out realized vol and FOMC on the table, which, yeah, we got FOMC. We've also got QRA, and we've got Japan's rate decision, which to me, Japan's rate decision is the biggest event that we still have to undo. So the 23rd to 29th, and then the 30th, and then we're into February, the 3rd and the 5th. Looking at the central pivot range for the week, we're above the weekly pivot point. That puts us in a bullish bias. For today's floor pivot, it's higher than Friday's. That's bullish. Price opened above it. That's also bullish. And we've hit it and we're still above it. And that's bullish. While all of that, that's a lot of bullish. Just keep some perspective, right? It only take a little bit of news to spook this market one direction or another. We're not looking at levels of, that has been laid out. Say by trading activity, key levels of option structure. We're talking about sentiment, just that warm, fuzzy feeling in the market and comments that have been made, and that's not good enough. So, when we're talking about this bullish bias and whether or not we want to stay bullish through the day, it's going to have to focus on options flows or news, because we know that there's no real big economic events today that could do it. So we had 2 weeks of the profile just kind of overlapping each other. We've started that breakout, but we need to keep it. To the downside, we've got 59.86. If we break through that, it gets a little shallow, but the previous week before that, we've got a point of control at 59.50 area. Kind of lines us up on the options structure. To the upside, we've got 61.32 cog line with a point of control from way back here. That is December 18th, the week of. So that's really the only thing out here that we could hit. $59.87 is the 10-day point of control. It doesn't line up with the TPO, which is down here at 59.50. So it's likely that we're going to see this shift and adjust. More likely the TPO goes up rather than the volume profile going down. And that's because of this here. This is where the point of control is, and we still have a little bit of candle here and here, but it's very likely that those two spots are not where the bulk of this volume came from. It's more likely that it came from here in the middle. If we, kind of lean on that logic, all of this is going to be gone before this is gone, and that's going to wipe a lot of this out. So unless we stay right here in this zone and build this out more, which will replace this as it disappears, then it's unlikely that we're going to see the point of control move up. It's also unlikely that this is going to top this out. As we lose more candles off of that, that's where the TPO should move up. So we're looking at price above 6,000 with the point of control on the 10-day underneath this as a structural support level backed by TPO. I'm not saying that we can't break it, just that it would have to be something really big to get that done. Looking at the 5-day, 5-minute, we don't have any new VPOC, whether we're looking at Friday or Monday. And right now, the volume profile and the TPO profile, they don't match. So we want to see which one of these is going to move. Either TPO moves up to where we're at, or the volume profile moves down. And I don't see that happening, right? We're already up here. It would be more likely that TPO point of control moves up to that 60-55 area. It's interesting how the point of control here lines up with that liquidity gap. So we're there, we're building out more structure. We don't have a lot of trades. We have a lot of volume, right? So that shows like we ran into an iceberg if we were dropping down into it, or that we hit like a ceiling as we ran back up the other direction and hit it. Either way, it wasn't a lot of trades with low volume. It was a few trades with a lot of volume. TPO is time, price, opportunity. So while these two profiles look very similar, one is a volume profile and the other, generically speaking, is a trades profile. So the one in blue is how many trades happened at that price, and the one in green is how much volume took place at that price. It's a really good distinction between the two. That may not be the textbook perfect definition, but if you use them that way, you think of them that way, it'll really help you out, right? And that's why we're looking at two of them and comparing the differences between them. So this is telling us there wasn't a lot of trades here, but there certainly was a lot of volume there, large trades. We need to keep above that. The problem is we're developing this in a zone. So we don't want to think about it as a single line in the sand. It's that 60-50 area, which is kind of underneath that zone. We want to see that act as a structural support level. We can cross back and forth through here as much as we want. If we leave the range and then we come back into it from below, back into it from below, then it'll act as a resistance. If we leave the range to the upside and we come back down into it from above, it would act as a support. But while we're just crossing back and forth through that zone, it's likely to act like a magnet or gravity and just hold us there as we crisscross that level. So on Friday, we examined the new week, comparing it to the week that we already had. The range that we're looking at is based on two metrics, time and volatility. Well, this week is a shorter week than last week, so there's one day missing. And then we can calculate volatility. It's hard to distinguish when we're missing an entire day out of this. So sure, this week is a more narrow range week than last week, but there's one less day. And that's very likely the only difference, that we still have volatility, things are still violent, and we're getting big sweeping moves, And we know that because the daily ADR, the average daily range, is still really wide. We are 1.2% above the 10-week. That's a good start, but we want to get farther away than that. Somewhere above 2% would be a good place to be. At this distance, it doesn't take much for us to get back below, say, 1%, and then we can fall right back down into the 10-week again. So we want to get further away from that 10. We are above it, and that's good, but that's not enough. We do want to get further away. We're 1.2% above the 10-day, and that's a good place to be. We're not overbought yet. We're not overextended. We haven't moved too far, too fast. And if we look at some levels that we've hit before, we've been higher than this and held it after we got there, right? We think about that recovery back in August after we had the carry trade unwind and the VIX spike into like 65. We rallied out of that and we got farther above the 10-day and stayed above that than we are now. Having said that, though, with this line that I drew, you can see we don't generally stay above this level for very long. We peak above it and drop back down. Right? That's the more common behavior. So probability-wise, it's more likely that we hold the range here and we give that 10-day time to catch up. And it's less likely that we continue to drive another 1% higher from here without first getting that digestion. I'm not saying that we can't do it, just when we ask the question, what's more likely? That we digest this high and we kind of hang out here and let things heal, or that we break this level, maybe test the next one, and or continue to drive up even higher into the next one, it's more likely that we stay here and digest. Either way, the green line here, the upper edge of the weekly expected move, does line up with this pivot point from back here, this one here. So we're at this level. If we can break it and we can get into this next one, that'd be a good place to digest. 6,100, we hold the line. Maybe we get above that as a structural level and we just stick the landing and hold it. That would give the 10 time to digest. Looking at things over a 5-day period, healthcare is barely in the red at about 1%. Everything else is looking really good, from 5% on financials, 5.5% on utilities, close to 4% on industrials, 4% on energy. So, over a 5-day period, we had a really nice recovery across most of the marketplace. Sure, healthcare is still down, but that's more of a defensive sector anyways. And the rising tide lifted all boats, right? That's what we were looking for last week. It's what I continued to talk about when we were hitting those edges or those extremes to the downside, and we were looking for everything to flip back and move higher. It's not necessarily growth versus value right now. When we look at something like this, it's growth and value. Sure, we need one side to be dominant, right? We need that growth to be dominant, the Mag 7, those guys. But we don't want to see, like we had last year, the Mag 7 doing all the work and the other 493 stocks just dragging their feet and not helping out. It makes the market too crowded in those trades. And then if one of those Mag 7 doesn't perform, everything starts to unwind, then it just really sucks. So far, it's looking pretty good. That's a really good start. We look at what's up this morning. We've got China stocks up the most. Bond volatility right behind that. That's a bit of a surprise, right? We don't see that every day. That's like the VIX for bonds right there, that move index. The problem is it's not a live chart, right? It's not like, you go to SPY, you go to the ES, you see it moving all day. This is a daily metric. So it's already been updated. We won't see it updated again today. And that's all we get for the bond volatility. So China up here and here. Then we got the Mag 7 up. We got the S&P 100. Gold miners, semiconductors, uranium, consumer discretionary, the Mag 7 again, China again, gold, financials, value and growth back to back there. What we don't see enough of yet is things like communications, banks, tech, transportation. So these are not up enough. Kind of flip it around and see what is down. Nat gas and volatility in the Russell. That's it. That's what we got for being down. Bitcoin is down, but not down enough to meet our qualifications. If I'm looking for a rally today, out of everything that we did see that was up, I'd want to see Bitcoin start to shine. If I'm looking for a reversal event in any of these other things to kind of galvanize or spike us higher in the S&P and the NASDAQ, I'm looking at Bitcoin. That'll be the one metric that, and it's due a pullback, right? It had already made a really good move. We're down just barely in Bitcoin this morning, but over a 5-day period, it's still up over 12%. After that big of a move, it's due a little bit of a pullback, yeah? So we don't want to see that really crash and burn. And if you want a continued rally in the S&P or the NASDAQ, we want to see that stop falling and or begin rising. At this point, we just take stop falling. We also have crude down this morning. So, we had that run up in crude and we've kind of topped out back at that same level that we've continued to top out this year. And now we're softening up a little bit. And nat gas, both energy, just two different sides of the coin. Nothing good in nat gas, at least from this. Maybe if you're looking at the spot, but there's nothing here. Cloud computing also down. Now, this doesn't get much when it comes to pre-market. A lot of times we just get a little algo print like we did here, right? We got this little print way down here. That's it. Well, that's not enough. We want to see more than that. So it's showing that it's down, but we'll wait to see how this turns out. We want to see some real prints in here, some candles starting to develop, some actual flows. Otherwise, it's likely that we'll see some shenanigans like we had back here, right? Where it was showing it way down here, and then it was gapped up, and it just kind of normalized. The carry trade unwind this morning, we look at Mexico, Japan, that's down 1%. So focus on the news, keep your eye on the clock. We got the call wall and the put wall structures that need to unfold a little bit. We'll get the AM edition founders note. We'll kind of read what they've got to say. The 1-day estimated move, pretty sure that this has already, this is done, right? That we would want to focus on our ADR levels since we've basically already taken out that 1 day estimated move. All right. So I got for you guys. Be careful, be safe. I'll see y'all tomorrow.